You're listening to the Falcon Method podcast, the audio content accompanying our monthly investment newsletter service. If you're new to the channel, our Falcon team is made up of die-hard value investors who are dedicated to helping you navigate the chaotic stock investment landscape. In this series, we provide regular updates on investment-related topics and recap highlights from our newsletter in a more casual format. Without further ado, let's jump into today's program. Welcome back, everyone. So today we are going to continue our series of company-focused analysis here on YouTube with none other than Alphabet, the undisputed leader of the online search engine space. And the reason why we decided to share our thoughts on the company is that it fares extremely favorably compared to the broader market, both in terms of quality and growth characteristics measured by a composite score in the EVA framework. Alphabet ranks in the top 1% of the Russell 3000 in this regard, thus it can surely be labeled as an EVA monster. It is definitely worthwhile to closely follow such exceptional companies, as we believe owning such businesses for the long run is the single most important factor for wealth accumulation. Let's take a look at the key metrics compared to the average company in the S&P 500. As visible in the summary table, Google trumps the benchmark in the quality dimension, both from a return on capital and EVA margin aspect. As a reminder, EVA margin is the EVA to sales ratio and is a good indication of a firm's true economic profit margin and competitive advantage, covering operating efficiency and asset management at the same time. Google does not disappoint in terms of growth either, since it has been able to grow its sales and net operating profit after tax at skyscraping 20+% annual rates over the past 5 years. At first glimpse, the valuation does not look exaggerated either, since Google's NOPAT yield is slightly higher than that of the broader market. This is usually a good sign, since our aim is to buy a company that is head and shoulders above the index from the quality and growth angles, while it is also trading at an acceptable or preferably attractive relative valuation compared to the entire market. So moving on, we're going to show you our analytical framework while researching a stock, and we are also presenting you the valuation tools we use when deciding whether to pull the trigger on an investment. Alphabet is a holding company with the vast majority, over 80% of its revenue streams stemming from online advertising, operating in an essential duopoly with Facebook. What you see now on the screen is Alphabet's revenue disaggregated by type. Its Google advertising revenues consists primarily of the following. Firstly, we have Google Search and Other, which consists of revenues generated on Google search properties and other Google-owned and operated platforms like Gmail, Google Maps, and Google Play. YouTube Ads consists of revenues generated on YouTube properties, and Google Network consists of revenues generated on properties participating in AdMob, AdSense, and Google Ad Manager. Google's other revenues, which amounted to roughly $6.5 billion last year, consist primarily of revenues from Google Play, which includes revenues from sales of apps and in-app purchases and digital content sold in the Google Play Store. We also have devices and services, which includes hardware, such as the Fitbit wearable devices, Google Nest home products, Pixel books, Pixel phones, and other devices. And lastly, we have the YouTube non-advertising category, including YouTube Premium and YouTube TV subscriptions and other services. Alphabet's dynamically growing yet still loss-making segment comprises its cloud offerings, which made up little more than 7% of Alphabet's revenue in Q1 2021, as the company aims to capitalize on the exploding global cloud market, which has grown at mind-blowing rates over the past years in the neighborhood of 30%, as you can see on the screen. As for Google Cloud's market share, it lags significantly behind Amazon's AWS and Microsoft Azure currently, while the growth rates leave nothing to be desired. In many ways, Google's cloud business is going through the same growing pains its competitors once did. For example, it took AWS nearly 10 years to become profitable for the first time. Thankfully, Alphabet is not dependent on Google's cloud business as much as Amazon relies on AWS. Lastly, Alphabet's venture capital-like investments are in its other bets segment, including various fields like technology to enhance health, like Verily, faster internet access to homes, like Google Fiber, or self-driving cars, like Waymo. And now we move on to assess Alphabet's quality. In the EVA framework, the EVA margin, which is the trailing 12-month EVA divided by sales, will serve as our ratio to define a company's moat. A 5+% EVA margin for 10 years is a telltale sign of a wide moat company. Google's EVA margin has averaged 16% over the past decade, consistently above our 5% threshold. As a result, the company's wide moat status has bulletproof evidence by the numbers. Judging from a qualitative angle, Alphabet's primary moat source is the network effect derived mainly through its Google products. Overall, the fact alone is mind-blowing that Alphabet has distinct platforms already surpassing 1 billion users, namely Android, Gmail, YouTube, Google Maps, Google Photos, and of course Google Search. Google remains the undisputed leader in the online search engine market, with the market share hovering consistently around the 90% mark. All the aforementioned products have provided Google with a massive consumer base that allows the company to collect data and offer the best return on investment for advertisers and build a growing network of advertising customers. Overall, we believe a wide moat rating seems fully warranted from a qualitative standpoint as well, since Alphabet's dominant online presence would be immensely hard to replicate. Moving on to our valuation model, we have always emphasized that our discounted EVA models can be useful as a vaguely right rather than a precisely wrong indicator of the fair value of a company, while it is far from a precise tool. It is especially effective in extreme cases when the share price and the fundamental performance of the underlying business are largely disconnected from each other. However, when we are analyzing such businesses like Google that score immensely high both on the quality and growth dimensions, our primary concern is to avoid significantly overpaying for the stock. The reason why is because the profitable growth of the company will be the major driver of shareholder returns in the case of such exceptional businesses, so anytime we could purchase the stock at or slightly below fair value, all we need to do is hold on to the position as long as fundamentals remain intact. And the reason why we use EVA instead of free cash flow in our valuation model is because this institutional level data shows the extent of true shareholder value creation, which makes it a superior measure of corporate performance in our view. That being said, the present value of a forecast for EVA is always mathematically identical to the net present value of discounted cash flows. For every company we analyze, we compute a conservative and an enterprising scenario and use those as proxies for our fair value range. As you can see, as an input, first we pull the top and bottom line explicit forecasts for the next 5 years. Based on that, we compute a forecast EVA compounded annual growth rate for the period, which comes in at over 20% for Google. Our conservative scenario assumes an explicit EVA growth of 12% in the period of 2021 to 2025, tapering off to 8% in 2026 to 2030 and to 3% between 2031 and 2035. We assume a terminal growth rate of 0% since no company can forever increase its EVA as opposed to free cash flow, EBITDA, earnings, or any other conventional accounting measure. That is because the number of additional investments where a firm can out-earn its true cost of capital, hence increase EVA, is always finite. However, Alphabet could very well be one of the few companies that are able to increase its EVA for several decades, but this of course remains a possibility and is far from a certainty. As a discount rate, we use Alphabet's 5-year average weighted average cost of capital of 8.3%, and the resulting fair value estimate arrives at roughly $2,000. Turning to our enterprising scenario, we project a more aggressive explicit EVA growth of 17% in the period of 2021 till 2025, which still seems reasonable in light of the 20% EVA compounded annual growth rate forecast, while assuming that the company can maintain a 10% EVA growth rate in the period of 2026 till 2030 and 3% between 2031 and 2035. The resulting enterprising fair value estimate arrives at about $2,500. As a conclusion, our discounted EVA-based fair value estimate for Alphabet falls in the range of $2,000 to $2,500, implying that its shares look roughly fairly valued to somewhat overvalued today at a price of $2,560. As a next step, we are going to reverse engineer the baked-in EVA growth rate from the current share price, as it can give us an indication of the market's expectations on the future growth trajectory of the company. At the current price of $2,560 as of July 14th, the 10-year baked-in EVA growth rate from 2021 to 2030 stands at about 15%, which looks realistic in light of the company's recent performance and growth runway ahead. That being said, it's somewhat high for our taste. We like buying in when the market's expectations are lower, and hence the company can easily surprise on the upside. And finally, the last step of our valuation of Alphabet is that we are computing our total return estimates for the next 5 years. On the right-hand side of the screen, you can see that we have dissected the different drivers of our total return. It becomes blindingly obvious that the vast majority of our total return is stemming from EVA growth. We assume a minor contribution from share buybacks in light of Alphabet's recent repurchase activity, but no dividend for the midterm future. These three components make up the fundamental return of Alphabet, which comes in at roughly 19% for the next 5 years, reflecting that the company's EVA monster status is undebatable. Last but not least, we have a sentiment change component that reflects a potential expansion or contraction in the valuation multiple applied by the market. Since Alphabet's shares trade at a rather stretched valuation today, at least in historical terms, even in the enterprising scenario, we assume a slight contraction in the valuation multiples, which weighs on our otherwise stellar fundamental return potential. Overall, our enterprising total return estimate comes in at 14%. Our conservative estimate calls for a more pronounced contraction of the valuation multiples to the range of historical lows, and that would decrease our fundamental return to the mid-single digits. And finally, on the left-hand side of the screen, you can see the midpoint value for the two scenarios. It would not be unrealistic to achieve double-digit rates of returns in the next 5 years, roughly in the range of 10 to 11%. As a conclusion, Alphabet is the epitome of the EVA monster category, with market-beating characteristics from both a quality and growth aspect. The icing on the cake is its reasonable valuation, and while double-digit returns can easily be in the cards on a decade-long horizon even from today's levels, we would get more enthusiastic closer to the $2,000 mark. That was it for today. We hope you have enjoyed this episode. Thanks for taking the time, and if you haven't already, please don't forget to like and subscribe to our channel. Thanks, and see you next time. Thanks a lot for listening. That concludes the most recent edition of the Falcon Method podcast. If you like this episode, please don't forget to hit the like button and subscribe to our channel to be notified of new releases. For a detailed analysis of our monthly top 10 most attractive stocks, you can start a free trial for our newsletter under the link in the description below and get a $40 discount off the standard annual subscription fee using the code TFMPodcast40. That is TFMPodcast40 at checkout. In the description below, you can find the link to our newsletter as well as our Seeking Alpha author profile. Make sure to check them both. If you have any questions, feel free to contact us via the email address in the description. Thanks again, and see you next time. Please note that this material is intended for educational and entertainment purposes only, and it is not a personal recommendation to buy or sell any stock or to adopt any investment strategy. The value of your investments can rise as well as fall, and there's always a risk of permanent loss of capital. Past performance is not a reliable guide for future performance. The investments referred to may not be suitable for all investors, and you should always seek personal advice from a qualified financial advisor. We can only answer questions of general nature and are unable to provide specific buy or sell recommendations or specific investment advice on an individual basis. In terms of full disclosure, we or a connected party may have an interest in the securities mentioned,